The numbers, your profit and loss budget. A profit and loss budget can help you identify the return your farm should give you if everything goes to plan. The budget created in your business plan does not get to the level of detail an operational budget your accountant or farm advisor would prepare. Instead, we're interested in the high-level numbers that become our scoreboard. Gross revenue. Your gross income from farming includes revenue received from the sale of produce and livestock, and farm-related goods and services that were either raised on farm or acquired for resale. Farm working expenses. Your farm working expenses include all your farm's cash working costs, excluding rent. They include animal health, breeding expenses, grazing and feed, fertilizer, repairs and maintenance, electricity, dairy shed expenses, wages, vehicle expenses, administration, insurance, rates. Interest costs. Interest costs is the cumulative interest paid on a debt used to obtain assets, maintain business operations, or pay for business expenses over the financial year, and is usually tax deductible. The interest recorded in your farm business plan should not include principal repayments. Lease and rental expenses. Rent and lease expenses are costs a farm incurs to occupy land, buildings, and livestock it doesn't own. Depreciation. Depreciation is an accounting method that spreads the cost of an asset that operates within the business for more than 1 year. Depreciation rates are normally set by inland revenue. The amount of depreciation claimed is located on your asset register and is tax deductible. Net profit before tax. Your net profit represents the excess revenue left over after all expenses are subtracted. This is the figure that will be used to calculate your tax obligation. The amount of tax you pay will depend on your ownership structures and marginal tax rates given your level of income. Personal drawings. Personal drawings are an accounting category used to record the transactions where the owner withdraws cash or other assets from the business. Each draw reduces assets and owner's equity and is not considered a business expense. A common misconception is that an owner is taxed on these drawings. It is important to understand that any business is taxed on its net profit. At a minimum, you should aim for your level of drawings to be lower than your net profit after tax.